Dreaming of replacing your 9-to-5 income with investment returns? That goal may be closer than you think, especially with a strategic investment in Palantir Technologies, known by its ticker symbol PLTR. Imagine turning a $50,000 investment into a primary income source. Sounds ambitious. Let's explore how this is not just feasible, but surprisingly straightforward. Your time is valuable, and I'm not going to keep you hostage. Here's everything we're going to talk about today. Number one, an introduction to Palantir Technologies. A quick overview of Palantir's role in AI and decision-making across sectors and why it's a strong candidate for investment. Number two, investment strategies with Palantir. A detailed exploration of a strategy with a $50,000 investment in Palantir aiming to replace a full-time income. Number three, real-world application, a practical guide on generating steady income through a time-tested, proven strategy. And number four, how to build a retirement income using today's strategy for long-term wealth building with conservative projections for investment growth and tips for maximizing returns. And if you're new here, don't forget to hit that subscribe button and ring the bell so you never miss an update. First, let's dive into a straightforward strategy you can apply today, boasting a potential annual ROI of 47.4%. Before doubt set in, let me clarify. All calculations are based on real-world data, including the bid, spread, and ask prices for Palantir stock and options on the date of this video. These numbers are not make-believe, these are the real numbers right now. And it's important to note that outcomes will fluctuate and we have to expect good and bad weeks. Today's figures suggest a 47.4% annualized ROI. However, for a conservative approach, consider this an optimistic scenario. Next, we'll explore how to adapt this strategy with a slight twist, treating it as a long-term dividend reinvestment plan, even though we don't have a dividend. This method is aimed at those focusing on the long haul, eager for steady income and growth. It's an excellent strategy for enhancing your long-term investment portfolio. Our first strategy involves investing $50,000 in Palantir and employing a covered call approach. A covered call is an investment technique for stock owners looking to earn extra income. It involves owning or purchasing shares, then selling the option to buy these shares at a predetermined price in the future. This sale earns you an upfront fee, which is yours regardless of outcomes. If the stock's price remains under this predetermined price when the option expires, you retain both your shares and the fee. However, if the stock price exceeds the limit, you may have to sell your shares at the agreed upon price, missing out on potential gains above this threshold. This strategy essentially allows you to rent your stocks for additional income with the limitation of capped potential profits. Considering Palantir's closing price of $26.04 on Friday, a $50,000 investment would allow us to buy approximately 1,920 shares. Given that one option contract covers 100 shares, this allows us to sell 19 covered call contracts. The question then becomes which covered call contract to sell. My preference is for weekly options, which Palantir has, or you could do the monthly contracts. It's advisable to choose a strike price above your purchase price, understanding there's a balance between the strike price and the premium earned. Today, we're opting for a 0.20 delta, offering a substantial premium with roughly a 20% chance that the call will be exercised, meaning you might sell your stock at that strike price. Looking at the March 15th option chain, we can see the 20 delta is the $28 strike price, and we can sell it for 24 cents per share, which is $24 per contract. Let's dive into the specifics with my free option analyzer available at jerryromine.com. We're now at my option analyzer, and I think I gave you guys the wrong URL. It's actually at beastmodeanalysis.com. Just click on option analyzer right here and it's completely free. So the first thing we need to do is put in what we're buying. So we're going to buy Palantir. We're going to use Friday's closing date, which was the 8th, and the closing price was $26.04, and we're buying 1,920 shares, and that's roughly $50,000 of stock. Next, we need to put in our covered call. So our stock is Palantir. We're selling it on Friday. Days out are 7, which gives us an expiration date of the 15th. We're going to be doing that on 19 covered calls, so that's 1,900 shares. Our share cost is what we paid for it, $26.04. and our covered call strike price is $28, and we're going to be receiving 24 cents per share, and then our total received is $4.56, and then we can come over here to our complete breakdown. Our adjusted cost basis is now $49,540.80, and that's because we picked up the premium, which adjusts our cost basis, which shows right here. Our total weekly income is $456. The annualized ROI, 47.4%. Estimated monthly income, $1,976, and estimated annual income would be $23,712. And then coming down a little bit lower, we can see our total wheel profits, if closed, would be $3,659. So what does this mean? Well, this means if the Palantir price goes up and closes over $28, then our calls will be exercised, and then we make the profit from that price as well. Our total ROI, if it's closed, would be 7.32%, but here's the crazy part. Over 7 days, the annualized ROI would be $381.60, and then here's a breakdown of everything. By employing the 0.20 delta strategy with a $50,000 investment in Palantir, we're looking at generating $456 in weekly income, which translates to approximately $1,976 per month. Considering my girlfriend and I managed to live luxuriously on less than $1,500 a month in Thailand, having $50,000 could, in theory, allow you to retire immediately. And if you live in the USA with a much higher cost of living, hang on for part 2. However, it's crucial to address the big disclaimer. This model assumes consistent weekly earnings and a perpetually rising stock market. Reality, though, is less predictable. Some weeks might bring in higher returns, others less. While I'm optimistic about Palantir, this approach can be adapted to any stock of your choosing. My goal with today's video is to encourage informed investment decisions and strategic planning towards achieving financial independence, aiming to keep it real so you can retire early and live. Now let's supercharge this strategy, and I'll show you how to reinvest earnings from covered calls, effectively utilizing them as you would in a dividend reinvestment plan. And if you feel I've earned it, a quick hit on the like and subscribe button shows some love and support for my videos. And for those diving deeper into trading, my Patreon has real-time alerts, and if you're curious about the indicators I use on TradingView, there's a free trial link down below. Thanks. And with that out of the way, let's use this strategy to grow a healthy retirement income. Please note, no calculator can precisely predict the growth of this strategy. I've demonstrated how we can achieve a 48% annualized ROI this week by purchasing Palantir at market price and selling a covered call. For visualization, we'll use a dividend calculator, and when you see dividend in this context, simply think covered call. First up, capital. We're starting with $50,000. Number 2, DRIP, the dividend reinvestment plan. We want to set that to yes to automatically reinvest our covered call earnings. Number 3 is distribution frequency, adjusted to quarterly to accumulate enough funds for purchasing additional 100 share lots. Though we're not dealing with dividends, we're using a dividend calculator just for simplicity so we can show the numbers. Number 4, the dividend tax rate. We're going to set that at 35%, and that's because covered call profits are taxed like ordinary income. Your tax rate might vary, so adjust it as needed. Number 5, initial annual dividend yield. Despite demonstrating a 48% annualized ROI from covered calls this week, we'll use a conservative estimate of 15% for our annual yield. 6, expected annual share price appreciation. Let's run with 10% for Palantir. Given that Palantir's 50% rise year to date, this is a very conservative assumption. This framework allows us to conservatively project the growth of our investment using covered calls as a strategic tool for long-term wealth building. Let's go over our initial settings, and remember, we're doing covered calls, but we have to use a dividend calculator, so there will be some tweaks. All right, let's go over our calculator settings, and again, we're doing this on covered calls, and there's no calculator that does this exact, so we're just going to have to work with what we have on the dividend calculator. So to start off, we want to set our distribution frequency to semi-annual. The DRIP will be set to yes. Our starting principal, we'll go ahead and put that at $50,000. Dividend tax rate, these are going to be covered calls taxed as ordinary income, so we're going to put in 35%. Initial annual dividend yield, 15%, and this is our covered call again, so this is what we're hoping to get on covered calls, and I think that's very achievable. And then our expected annual share price appreciation, 10% per year, years invested 30, and we're going to tweak this one in just a minute, but for right now we're going to set this to 0. So now we hit calculate dividends, and we can see our ending balance would be $2,179,000 and some change. And if we scroll down here, we can see our first year, the principal is $50,000. Our annual dividends, this would be our covered call income, would be $7,781. That would be a 15% yield. And at the end of 1 year, whenever we take into account the 15% yield as well as the share cost appreciation, would be up to $60,057. And we could scroll down and look at our 10-year amount. Our principal would be up to $206,000. New balance over here would be $235,000. 20 years, $688,000. 768, pretty impressive. And at the end of 30 years, we're sitting at $1.97 million for the principal balance, and the new balance would be $2.18 million. Now, however, we've got one problem with this, and this is our yield. The first year, our yield was 15%. The next year, it goes down and down, and that's because this is normal for dividends. However, we're going to be doing covered calls, so we should be able to keep that yield right around 15%. And what we need to do is change our expected annual dividend amount increase. Now remember, we're on covered calls here, so we're going to be able to hold that at a constant value. And the way we do that to make it match would be we'd set this number to be the same as our share price increase. And when we do that and hit calculate dividends, I'm almost hesitant to show this number because it jumps so high. Our ending balance, $12 million. Now, if you come down here and we look at our chart, we can see that the yield is now 15%, and this would be our covered call yield each year. So that way we're going to be growing in line with what our projections are. And again, these numbers are astronomical, but don't get mad at me. This is the math and what's possible. Now, in the real world, will this happen? Probably not. There will be some different changes along the way, but if we can get anywhere close, well, we'd be doing okay. And now to keep the numbers really conservative, I switched this back down to zero, but I want to show you one more advanced thing for you guys to consider. I love to do investing in my retirement accounts. They're all tax advantaged. If you can do it in an IRA, it's going to be tax deferred. If you can do it in a Roth IRA or Roth 401k, it's going to be tax free down the road. So what we could do for the advanced guys that can do this in your retirement accounts, let's change the dividend tax rate, and let's assume that we're going to be doing this in a Roth IRA or a Roth 401k. We're going to drop that down to 0%. And now whenever we calculate, look at how these numbers changed. It went all the way up to $3.5 million for an ending balance, and that's simply the difference on taxes. So if you can do these sort of things in your retirement accounts, definitely please consider doing that. Of course, you always want to do your own due diligence and do what's best for you. Wrapping up our deep dive into Palantir, here's a powerful takeaway that resonates with every investor, seasoned or just starting out. Building wealth doesn't require huge amounts of capital. Our strategy with Palantir demonstrates two methods to generate substantial income, potentially substituting $50,000 of annual income over time. My optimism for Palantir sees it as a potential AI industry titan like Google or Microsoft. Success isn't guaranteed. This strategy may be viable with Palantir for 1, 5, or 10 years, maybe more, but the key is adaptability. We can always find new stocks that fit our criteria and produce similar results. And if you don't like Palantir as a company, then find one that works for you. Palantir highlights the effectiveness of a solid covered call strategy, amplified by the power of reinvesting our covered call profits. And if you can do this in a tax-deferred retirement account, your profits will be considerably higher. And here's the kicker. The numbers I shared in the covered call reinvestment strategy, they're on the conservative side. I've used a much lower share appreciation rate for Palantir than their actual historical performance, and a very conservative 15% yield for the covered call strategy. So imagine the results it could reach with the real numbers. Now let's tackle 3 common questions on covered calls. 1, weekly versus monthly covered calls. Can you opt for either weekly or monthly covered calls? Absolutely. My preference leans towards weekly covered calls. Why? They tend to be slightly more profitable. This is because options lose value quicker as they near expiration, a beneficial aspect for us when selling the covered calls. Number 2, dealing with a drop in stock price. What if the stock's price falls below your purchase cost? You can still engage in selling covered calls. Be aware this approach is more advanced and requires careful consideration. I'm open to diving deeper into this topic in the future if there's enough strong interest. Let me know down below. And number 3, why does the annual yield decrease in the calculation table? The decrease in yield is due to the calculator's assumption of an increasing stock price over time. When we input a 15% yield target, remember that yield is calculated as the annual returns from covered calls divided by the stock's price. Therefore, as the stock's price climbs, maintaining a fixed 15% yield results in a decreasing yield percentage over the years. Today's video isn't just about investing, it's about smart long-term investing and utilizing low-risk covered calls to grow your income or retirement portfolios. Hopefully my video has inspired some critical thinking about Today's video isn't just about investing, it's about smart long-term investing and utilizing low-risk covered calls to grow your income or retirement portfolios. Hopefully my video has inspired some critical thinking and maybe I've opened your eyes to the possibilities with covered calls. To access real-time trade alerts, consider joining my Patreon community. For those interested in the trading indicators I use on TradingView, check out the free trial link provided below. Keep it real. Peace.